Okay, the next one we will look at the different method of evaluation on the personal risk. If let's say there is a premature death happen to an individual. So basically there are three different methods. First will be the concept of human life value. So the next one is the capital need method. So the capital need method, we have two different approaches. First is the capital liquidation method. The next one is a capital conservation method. Okay, so the capital liquidation method, basically we calculate the total financial money that we need, okay, for the certain period of time. The capital conservation method, so we try to keep those financial and keep it to our next of kin and so on and so forth. Okay, so the next discussion I will focus on the human life value in more detail, to how to calculate and how to do the measurement. Based on the individual income earning ability or the potential income earning ability, so the amount of the income that the person would earn over the remaining duration of working life up to the point of the retirement. Like example, if let's say an individual current age is 30, unfortunately for the premature death, then the human life value will calculate the remaining duration of the working life until the point of retirement. So that means for the next 30 years. So the human life value is define the present value of the potential income lost by the dependents as a result of the premature death. So the computation of the present value is used for the computation of the human life value. You can see the formula here for the PVAD equal to the A 1 plus R, okay, and then 1 minus the 1 plus R power of your N. So the whole formula will divide by your R. Okay, so where the PVAD actually is referred to the total income required to meet the annual income needs for the N number of the year. So for the A, measure the annual income needs. So for the R, measure the interest rate at which the total income will be compounded. So for the N is the number of years from the current age to the age of the retirement. So from the calculation based on this formula, we will know how exactly what is the potential income that, okay, the dependents need in order to support, okay, for the family as a result of the premature death. Okay, so even though this is very critical, but at least so we can get ourselves, okay, prepared. So if let's say anything happen to the policy owner, so at least they have the money to support for their family. Okay, so on this concept, basically there are few limitations, so need to highlight. Okay, first we assume that the salary to be unchanged for the entire period. Okay, let's say for example for the next 20, 25 or 30 years. So the interest rate is assumed to be constant throughout the period. Okay, so by right the interest rate should be volatile up and down. So we have to assume to be constant. Income need is also assumed to be unchanged over the period. Therefore, ignoring other evolving needs such as, for example, the lifestyle changes, education needs, and so on and so forth. Okay, inflation rate is ignored, so we don't consider the inflation in our human life value computation. Did not consider the person may work or to be involved in the income generating activity after the retirement. Okay, so we don't assume the person will continue to work, okay, after the retirement. That is why the calculation, okay, will be from the balance of the life until the retirement age. Okay, assuming the economic value of an individual will generally decrease over a period of time as the person moves closer to the retirement and become zero at the point of retirement is not true in the reality. So in the human life value calculation, okay, basically we assume there are a lot of unchanged, like in terms of the salary, interest rate, and also the inflation. At the same time, we also assume, okay, so the economic value of an individual by right, okay, should be higher when you have gained more experience and so on and so forth. So, but now, okay, we are not going to consider, okay, the economic value of an individual. So a person is closer to retirement, the human life value can increase due to the increase in the salary. So this is also one of the limitations from the human life value computation. Okay, so because of the salary increment is not considered when a person is closer to the retirement. Okay, so the next discussion, I will show you some short cases in order for you to better understand the human life value concept. Okay, another method to evaluate a personal risk will be the capital liquidation and also the capital conservation. So now we focus on the capital liquidation and capital conservation. So for the capital liquidation, okay, basically the principal and a portion of the interest will be consumed in the meeting of the projected income need. So that means we need to know, so what is the projected income need by an individual. Over a period of time, the fund will eventually be used up. Okay, so that means, like for example, just now we look at the human life value is sustained for the next 25 years or 30 years. Okay, basically the money will be used up, okay, within these 25 years. Okay, so there is no residual amount, so there is no balance of any funding based on the capital liquidation approach. The period will be dependent on the amount of fund provided, the amount of money required, and the interest rate available. So as usual, we need to identify, so what is the total required funding for the insurance protection, and also we need to identify, so what is the interest rate. Okay. In the capital liquidation approach, the assumption used for the calculating the sum assured is similar to the methodology used in the human life concept. That means there are a lot of factors, so we should ignore like those salary should be constant, there is no change in the inflation, and so on and so forth. So what the number of years used in the human life value approach is the difference between the retirement age and also the current age. So the concept of capital liquidation fixes the number of years for which the income is needed for the dependent. So it means, so for the capital liquidation approach, then we can identify how much that you need to use for your family members. So for the human life value, so we fix it, okay, until the retirement. So for the capital liquidation, you can, okay, assume until the life expectancy age and so forth. Like for example, until the age of 80, okay, 75. So the next one will be the capital conservation. So the capital conservation is another method to evaluate, okay, so the personal risk. So for the sufficient funding is provided so that the investment earning alone will supply the income stream without depleting the original capital sum. So that means if let's say this is a one lump sum you need, let's say for example 1 million, and then the 1 million, okay, will not be going to deplete, okay, after 30 years and so on and so forth. So that means the money will keep, okay, so for the next of kin and so on and so forth. The formula for the capital conservation approach, okay, you use the present value concept, okay, equal to the annual income need divided by the interest rate for the compounding impact. So for this capital conservation, so we will calculate the present value to represent the total income need to meet the future annual need. Okay, so the lower of the interest rate, okay, looking at the formula, so the higher the capital sum require the higher interest rate than for the lower capital sum. So that means, so if the interest rate is lower, then we will have a lower capital sum. So if the interest rate is higher, okay, basically you will get the higher capital sum. Okay, so there are two approaches here for the capital liquidation and also for the capital conservation. Both methods also can evaluate, okay, so for the personal risk, but the difference, okay, so for the capital liquidation, so we try to utilize all the money, but for the capital conservation, so we try to retain those money in order to benefit for the family members. Okay, so the next we will look at the short case, okay, in order for you to better understand the evaluation of the capital liquidation and also the capital conservation.